Okay, return to the S corporations. This slide, I'm not going to hold you to the actual material itself, but the main thing I want you to get out of it is the fact that this reflects the concept of separately stated items. That whatever they are at the S corporation level, whatever they are preserved when they pass through to the individual shareholder. That's why we saw all the different lines on the K1. So that's what this really reiterates, and I just want to make sure you get that. Okay, this should be somewhat of a review of some of our other tapes, particularly videos 1 and 2 in this series. Let's see what we got here, because we talked about bases and distributions. Let's see if we can figure out what all this means. Now, when it says bona fide debt is the standard, in that formula of basis, you will recall that it was what you put in is a plus, what you take out, so we'll call it distributions this time, is a minus. What you loan to the company is a plus, and if you pay back the loan, it's a minus. And of course, income earned by the corporation and passed through is a plus. Losses lost by the corporation and passed through is a subtraction, and then you get basis at the bottom if you put it all together. So when it comes to the loan, what the rules are is that the loan has to be really a loan from the shareholder, and it means real debt. It cannot be a guarantee of a debt that the shareholder is guaranteeing the S corporation debt. That doesn't work. It has to be a real loan. All right, and that's all you need to know for this course. There's some more detail to it, but you'll cross that bridge if you get a research question somehow, or something happens when you go to work in the tax department with debt. Then you'll be looking up the details. But the biggest thing to know is it's just got to be a real loan with a promissory note. The whole works. Guaranteeing a loan does not work. That's the main thing for this course that you need. We talked about deducting shareholder losses to the extent of basis. Remember, that was rule number 1. What you can deduct from a pass-through entity if it has losses, rule number 1 is it must have basis. So that's why we need it to know basis. That's why we need to follow it, and we need to keep track of it year after year after year. In case there's a loss, can we take that loss on the shareholder's return? And of course, the basis we're referring to is the shareholder's basis in the S corporation stock. And this we talked about as well, that losses that cannot be deducted because of this limitation, the basis limitation, they get carried forward. And if basis is returned, if basis goes up later on, then the loss can be taken. Here's an example. Let's see what we have here. Katie owns all the shares of KB. And S corporation, her basis at the beginning of the year was $10,000. At the end of the year, passes through a loss, non-separately stated loss. Why? Because it's an income. Remember, income is considered a non-separate, well, in this case it's a loss, but income or loss from the business operations is considered non-separately stated. So, and she has no debt basis, so her only basis at the beginning of the year was, as we said here, it was the $10,000. The corporation made no distributions. Let's erase some of this so we can see it. See what I'm talking about? Corporation made no distributions. So she started with $10,000. Let's do the math. She has a loss of 15. She can only use 10. Her basis can only go to 0, and the 5 gets set aside, basically in the AAA account, and carried forward to be deducted in a later year when she has basis. All right, this should be easy for you now. Yay. All right. S corporation taxes at the end of the level. Well, generally there are none. That's what you should say, because we learned it's a non-taxable paying entity. But there's a few exceptions, as tax law always has exceptions. And you're lucky in this class that I don't think there's exceptions to the exceptions. At least we haven't come across any yet. Basically, what I'm going to hold you for in this class is not the details that we're looking at right now. Right now, I think the way we'll do this is that S corporations can have taxes at the entity level under the following circumstances, and this pretty much covers everything, I think, where it can happen. It would have had to have been a C corporation. Oh, I know where we're going to go with this. Let's go the following way. Let's take a break. Well, not a real break. Let's do the following. Let's clear the deck. There we go. Let's clear the deck. And let's go to the beginning. In the beginning, when God created the heaven and the earth, oh, that's the wrong beginning. This beginning is, a corporation starts off, we learned that when it first starts, when it's first created, it's a C Corp. But you say, I don't want to be a C Corp, so we learned you make an election. And this election now is what's known as the check the box. It's the new terminology, because it's on a form where you check the box, we want to be an S corporation. So the form has boxes, you check the box what you want to be, and that's how you make your election. So C corporation can make an election to be an S. It doesn't have to do it right away. There could be a scenario where the C corporation gets formed and 10 years goes by. And then suddenly it dawns on the CPA that this C corporation would be better to be an S corporation. So it checks the box, it makes the election after 10 years. So we'll say checks the box. All is well and good, you can do this, no problem. Not even a taxable event to become an S corporation, except for one particular issue. If the C corporation had E and P, and you remember that, earnings and profits, not equivalent to retained earnings for an accounting standpoint of GAAP, but pretty much the same idea. If the C corporation had earnings and profit and had not paid it all out as dividends, which would subjugate it to the double taxation that we learned about until the point when you wanted to throw up, and then it makes the S election, the worry that the tax law had was you would, under the S election, you would try to pass out this E and P, where it's not going to be subject to tax to the extent of shareholder basis, and whatever the details would be, you were thinking, well, let's make the C corporation, let's make it an S, so that we can hide the earnings and profit from a double taxation, since the S corporation is only taxed once. At the shareholder level, it's not taxed itself. So the tax law comes along with certain rules where the S corporation can pay a tax, and it's the equivalent of the double tax that the C corporation would have paid if the C corporation hadn't made the S election. That's the idea. It's just laws, it's tax laws on the S corporation just to prevent taxpayers from getting too clever with their CPAs and trying to make the S corporation election and avoid the double tax on whatever E and P had been accumulated by the C corporation. So, for example, if, I'm not going to do the example. I just want you to get that principle. This principle is all I think I want you to get. There's one other aspect of principle, but we're not there yet. So for right now, this is basically what you know, is that if a C corporation goes to an S and it had E and P, then you got to watch rules for potential taxes to the S corporation under certain circumstances. You'll just have to watch it. That's all I think you can learn from a course that's not specifically a S corporation course or a corporation entity taxation. If we didn't have to do partnerships, we'd have time to go into this, but we just don't have time for it. Nor do I think they expect you to get it out of the curriculum here. So you can read about it and see if you can follow it along, but we're going to skip it here. Okay, so I think that's enough for now. We'll pick up at this point, and then we may be ready to conclude. We'll see.